On day 3 of the 2021 Nigeria Fintech Week, stakeholders explored in the panel session how to scale sustainable investments for the growth of the fintech industry. It was an opportunity for seasoned investors to share what they look out for in the fintech ecosystem to attract investments. The session was moderated by Ronke Kuye, the CEO of SANEF.
Probably best to start with how we look at the financial services sector in general. So we have 5 large buckets across which we categorize companies. So that's payments, credit and savings, insurance, a bucket that we call service providers, which is effectively a catch-all for any tech company or software company providing services to one of the major buckets. And then the last one is capital markets. Now, if you overlay these subsectors against the structural drivers I mentioned earlier, some themes begin to emerge, whether that is the movement from in-store to online or from cash to digital, so new payment rails effectively, or whether it's alternative distribution models. I think Tokunbo spent some time on embedded finance. So we also, for example, have an investment in the off-grid solar space. I think a question is always asked around, why is a fintech investor investing in the off-grid solar space? One of the things there is that if the populations that these devices are sold to cannot typically afford a $100, $200 device. So what we do, the company's called Greenlight Planet, it allows the customers to pay a deposit and then pay for the device over time. And what that does is it creates effectively a credit history for customers or individuals that wouldn't have typically had one and wouldn't have typically been able to get a loan from a bank. Some other themes we see, big data. So as everything moves digitally, everyone's leaving a footprint behind, allows you to collect data and do interesting things with it.
The Alistair Capital was founded on the premise that we should be able to take the disciplines of finance and combine that with a heart to really invest to make it possible for people to have access to affordable, essential goods and services. And so our key motivation is really about building an inclusive economy. And we look at opportunity to make a good return, financial, and opportunity to make good returns, social and sustainable. So on the financial, we all have that in our minds and we all think about that. On the social and sustainable, for us, it's like, how can every Nigerian, how can every African reach their full potential? What are those things that they need? For us, from the very beginning, we spoke about access to finance. Finance is the oil, the fuel that makes the economy go round. It's the blood of the economy. Yet, at the time when we started the company in 2007, over 65% of the population did not have access to finance, whether that's access to finance for their business, for working capital, or whether that's just access to finance as a household to be able to leverage their stream of income and therefore access other services or affordable housing or proper energy infrastructure in their houses. So we knew that finance was the first area that we absolutely had to cover and see how we could drive on that inclusion. And then once you have finance, what are those things that you spend money on? Energy. SMEs spend over 70% of their costs on energy infrastructure. How can we make it possible for them to have better access? And at the time, that led us to think about off-grid technologies and also the smart metering technologies that can drive that kind of energy conclusion. And then from there, it's like, well, people have energy, but people want to own their own homes. So access to affordable homes. And so again, that access is a key motivational factor for us. How can we drive access and how can we leverage technology to do that?
Here, we focus on 3 core sort of pillars as we assess companies, the team, the product, and the size of the market. Again, it's really important that the market size is large enough and growing to support venture returns. but also because we are in Africa, we always like to see what we call positive offline indicators that suggest that the cost to educate the customer won't be as prohibitive as you could accommodate in some other markets. I guess out of those three core pillars, team, product, and market, because we invest at the earliest stage, and like with the example I gave of this company that's female led that we're backing for the second time, we can only do that if we've applied a really significant weighting to the team. Again, it's really about backing exceptional founders who are relentless, who are gritty, and who will give it their best shot, such that even where the original product or company fails, you know that you have a founder that is gritty, and this gives you confidence to consider a second go at it.
Sourcing finance actually can be a very challenging experience for women around the world, regardless of where you are. You know, we still have a very shortfall in terms of access to finance. But everything that Tokunbo was saying, that, we cannot really ignore that demographic, because I think, especially in Africa, a lot of our women-led businesses and small medium enterprises, of which 70-80% make up Africa, are really kind of led by women. So for me, I think it's very, very important that we do make it a little bit more, we make a bit more of an effort as investors to actually look to say, how can we, if there are barriers in terms of investing into women, how can we tackle those barriers, right? And how can we become a little bit more targeted and a bit more tailored in our approach in terms of supporting female-led businesses to actually access capital? This is a problem that we're facing around the world. And I think in Africa as well, one of the things that we actually need to think about is what's coming ahead, right? We're moving into a digital economy. We are in a digital economy. Yes, we're going to have quite a lot of fintechs that come in with tech products, but we're also going to have traditional activities happening, be it around agriculture, be it around, processing, manufacturing. And we want to be able to support these sectors. And most of these sectors, especially the informal sector, we have a lot of our women doing work in there. Not many, funds are really focused at looking at the early stage, for example. So for me, it's very important we start to think about, we combine the access to finance as well as, the business support element, which is also looking at things like, accelerators for businesses to get women through accelerators so they are ready for investment. So we need to be able to look at investment readiness packages that are designed and tailored specifically to help women to get to the stages where they are investable and they're investment ready. That is really, really important.
Also at the event, Mr. Ali Hussein, the chairman of the Kenya Fintech Network, shared how the ecosystem has evolved in the East African nation and new steps being taken to deepen it.
Kenya has been, as you rightly said, at the bleeding edge of the fintech ecosystem, not just in Africa, but around the world. I would credit that with, number one, a very enabling environment, entrepreneurial environment, an enabling governance environment. Politics, as I always say, is the operating system of anything in any country in the world. If your politics are not okay, then business cannot work. So despite sometimes people say that our democracy is chaotic, I would dare say that I would rather a chaotic democracy than a peaceful dictatorship, although that in itself is an oxymoron. Having said that, the enabling regulatory environment to date has enabled players like M-Pesa, Cellulant, and everybody else to actually work. I think in Kenya, we have hit what I would like to call the FinTech 2.0. We are now geared towards FinTech 3.0 and beyond. And FinTech 3.0 will entail a lot more, will require a lot more from the ecosystem than it currently has. And when I say this with all due respect to all players in the ecosystem. And when all players, I mean the the Association of Fintechs in Kenya, where we have more than 125 members and growing. I talk about regulators and policy makers. I talk about the VC industry, the VC sector. I talk about the non-governmental organizations like the Kenya ICT Action Network and so on and so forth. A multi-stakeholder engagement. It will entail everyone to work together harmoniously with one goal: to grow the fintech ecosystem, which basically means that if the fintech ecosystem grows, it means that the whole economy grows. You know that we are talking about agri-tech, we are talking about ed-tech, we are talking about all other techs, but the engine is fintech.
Indeed, as the fintech ecosystem continues to evolve in Nigeria and Africa, it is very critical that it continues to become the hub for attracting investments and also enabling regulations are put in place to boost its activities that will unlock opportunities for products and services that can deepen financial inclusion and also foster economic growth.